Welcome to TheoTrade. This is Don Kaufman. It's July 29th, 2019, and you are watching the TheoTrade evening video. We're just a few minutes past the cash close where the S&Ps, did a whole lot of nothing today. This entire week is kind of loaded towards the Fed, which is effectively coming out on Wednesday, the jobs number, which will be out on Friday before the bell. But before we even get there, it's going to be all about Apple. Now, I'm not necessarily sure that Apple is going to spark volatility to the marketplace, like, of course, the Fed or the jobs number would. But Apple coming up, being one of the largest market caps and one of the most highly anticipated stocks to release earnings, well, all eyes right now are on Apple. And my big question is, will Apple really come up short? One of the first things that I wanted to take a look at in this evening's video, this is just a 1 year on Apple, which is a fairly tumultuous ride to the downside, to the upside, to the downside, back to the upside. It's Mr. Toad's wild ride. But, one of the things that I'll point out about Apple, just pop open here like the last 3 years, earnings are not a given to the upside in Apple. And I've actually gone back and done a little analysis on earnings like, there's some gaps to the upside. Here's another gap to the upside. In terms of earnings, this is actually a gap to the downside. When you start going through all the earnings, another gap to the upside, it's about even in terms of how many times Apple's gap to the upside versus the downside. And I don't believe that there's any real evidence or supporting evidence or even worthwhile, in looking back at gaps to the upside or the downside in terms of earnings. What I am much more apt to do when I'm looking at earnings, I'll cruise over here to the trade tab. I'm going to go ahead and I'm going to close up this left side bar. I'm going to open up the options that have 4 days remaining to expiration. And with that, I'm just going to highlight this for you for a second. Now, I'm looking at the shortest duration expiration possible. Not necessarily because I'm ready to build the trade, but to really get a feel for what are the option markets. What are they actually saying about risk right here, right now? And it's saying that Apple, is very likely to move about $9.60 on this earnings announcements, and basically a 50% implied volatility. Now, if you stop right there, you're like, okay, that doesn't do anything for you, because if you don't know Apple, then looking at this implied volatility and looking at this expected move it's useless. So what I suggest that you do is to do a little bit of homework. Go back to the previous earnings announcement, which was on April 30th. To do that, I'm going to go to the Analyze tab, and I'm actually going to drop back into what's called Think Back. Cruise over here to the calendar and drop back to April 30th. And I'll open up options at that point, And you can take a look at Apple in the previous earnings period. Here's the implied volatility, the expected move. Now, the last time around, Apple was about a $200 stock when it had earnings. Right now, it's about a $209 stock. So the differential there, I would believe, is rather negligible, right? You can see that the implied volatility is a little bit lower here, but that doesn't include tomorrow's trade. So you're going to see this implied volatility come up a little bit. What you're going to find out on this front is that the implied volatility of this particular earnings period, is slightly lower, just minimally lower than it was in the April kind of time frame. So why am I going through this? Well, there's a lot of people that around earnings, they try to, they're buying options, they're selling options. Well, in this particular case, being an option premium seller, doesn't look all that advantageous as the volatility is actually slightly down from the previous earnings announcement. But don't take my word for it. And don't just take one other earnings period for it, Go back. All you got to do is just go back here to the dates and go like, this last one was April 30th. What did we look at before that? We could look at what? January 29th. It takes 2 seconds to actually knock back then. Here, January 29th. Boom, we got it. All right, now it's $154 underlying. 3 days left. You can see there's almost 75. So the volatility here was a lot higher. What you're finding out, the volatility is rather diminished versus the previous two earnings. Okay, now that's just to help you for those of you that are premium buyers versus premium sellers. But let's not geek out too much. Another aspect that I will often look at prior to an earnings announcement, I will look at its peers. Okay. Now, when it comes to Apple, I don't look at just any peers. Like, what? Apple has no peers. Okay. I'll look at the rest of what I would term the monsters of tech. If you look, for example, at Microsoft's earnings, okay, they came out. The stock actually ran substantially higher and reversed on the trading day, only to actually run back up, though, thereafter. And that's important. It ran back up thereafter. So Microsoft, technically, after the earnings, okay, was rather bullish. It did effectively gap up, sell off, and ran a little higher. We come down to like Netflix. Netflix is not categorically speaking one of the big monsters of tech, okay? But because of its volatility, all right, this really, it deserves kind of a shout out. Netflix obviously gap to the downside and a wicked gap to the downside, got bid back up. Nevertheless, it's about a 2 standard deviation move to the downside, which then brings me, of course, to Facebook. Facebook, kind of a wicked reversal off of its earnings. We look at Amazon. Amazon was effectively swing and a miss. They didn't love it. Stock sold off a little bit. We come to Google. Now, the reason I bring up Google is as phenomenal to the upside, okay, as Netflix was ugly to the downside. And quite frankly, in looking at some of the monsters of tech, the peers of Apple around this coming earnings announcement, it is a really clouded picture right now, extraordinarily clouded. Amazon, they kind of missed, but that was due to expenses. Google, they hit it out of the park, but Google, a lot of this didn't just have to do with earnings. It had a lot to do with the stock buybacks that were announced. Microsoft, okay, mixed bag of goods, some good traction. It just goes on and on. Apple, and again, that brings me back to the question, will Apple come up short? This is a quarter where I would very much consider iPhone sales, okay, and the possibility of iPhone sales plausible that it could be in a little bit of trouble. This would be a quarter where kind of that peak of the China-U.S. trade war could come into play. iPhone sales, okay, may not necessarily be blistering. Now, they're not actually providing specifically those numbers to the iPhone sales. What Apple is going to do in this earnings announcement, they're going to downplay the iPhone, okay, and they're going to play up their services business. The question is it going to come up short? Is the services business going to come up short? Now, you know, if they're going to come up short, they're going to come out there and they're going to buy back a ton of stock. Okay. Is the marketplace effectively going to buy it? Is the marketplace going to buy that idea? In this example, right here, right now, again, with about a $9.60 expected move. By the way, this couldn't line up any better. About a $9.60 expected move. The stock is trading at 209 and change. I'm probably going to align a butterfly, okay, to the downside. Again, a butterfly to the downside right on the edge of the expected move. However, I still have to let this product trade a bit more tomorrow. I'm not ready to fire off a butterfly at the cash open. How to actually do this, I'm going to right click, I'm going to go buy. I'm going to come down from buy to deep and wide, okay, 1 month, 2 strike. Butterfly. It's going to bring up a $5 wide butterfly. As I bring up that $5 wide butterfly, it's trading for right around 60 cents. It's a cheap shot to hitting the edge, the downside edge, okay, of the expected move. Now, there might be a lot of individuals, okay, that are watching this, a little bit of naysayers, take the opposing side of it. It's okay to do that. This is trading. You know what makes trading, okay? Very fair, very balanced, because there's both buyers and sellers. If you don't like the idea of trading to the downside Apple expected move, take a shot. Take a shot up to the 220 strike for that butterfly. Nevertheless, okay, I believe there's going to be a degree of pressure to iPhone sales. Another iPhone cycle coming out here in September, right? The height of the Chinese-U.S. trade war likely to take its toll on Apple. Thanks, everybody, for joining us here at TheoTrade. I'm actually going to go through a number of these Apple trade ideas tomorrow live in the TheoTrade chat room. Have a wonderful evening. Bye-bye.